Today I will show you how to add 200 million or more to your company valuation so that you can sell for north of $100 million. So here's how to do it. First of all, I'm in Vegas. This is the encore and the wind behind me. It's 06 a.m. Today I'm going to level 2 of Alex Hormozi's value acceleration method. It's a $45,000 offer. In this workshop, you learn how to add value to your company. I will show you how this can look like, how to add 200 million to your enterprise value. So if you want to sell for north of 100 million, then this is the way to go. So let's go. Let's dive in. Here's how it works. So this here is a business scorecard. You take here your revenue and your EBITDA. Then you have things which are called value adders, because in the end, if you want to sell your company, the question is always what's the multiple that's being applied to your business. For example, you make X amount of revenue or EBIT and you get a multiple of that, and this is then the value that you can sell it for. In most cases, this is EBITDA, but if you have a SaaS like I do, then it's based on revenue. I will share more on that in a second. Then you have a section which is called value adders. What are value adders? These are adding points to your multiple. So for example, you might have a multiple of 2.5 or 4. If you do these things, you can get it up to, let's say, 10. And then you have value subtractors. These are risks that when they happen, they actually take a score off your multiple, and you then in the end can get an even lower valuation. So to give an example, if you have, let's say, revenue of 15 million and you have an EBITDA of 1.5 million, you think, okay, this is amazing, the company is worth a lot, right? You get for that an EBITDA multiple of 2.5x. Here the scoring is less than 1 million. You get a 1x, 1 to 3 million, 2.5x, 5 to 10 million, 5x, and north of 10 million EBITDA, 6x. You might have to question what happens between the range of 3 to 5. It depends, right? Just go with what you think makes sense. Are you closer to the 5? Go with 5. You're closer to the 3, maybe use the 3, right? 3x. Then value adders. If you're growing like crazy, you very likely know the rule of 40. Rule of 40 means the sum of your growth rate, your growth rate and EBITDA margin. If that is north of 40%, you're in the rule of 40. You're worth significantly more than if you're not in the rule of 40. Like rule of 30, rule of 20 is worth nothing compared to rule of 40, right? Like it's the thing, the yardstick in the investor community. You want to be above rule of 40 or more. If you are not making EBITDA or you're burning, you need to be more than 100% growth. Crazy growth always outperforms EBITDA. Okay, so if your revenue growth, let's say, is 20%, you get a 0 because 0 to 30% is a 0, 30 to 100% is a 1, and north of 100% is a 2. Then revenue retention, less than 80% revenue retention is a 0, north of 80% is a 2. Important here is the more you have, the better, because that's ultimately what makes companies, especially software companies, a revenue printing or money printing machine, right? For example, let's take Slack. You take the cohorts 2015, 16, 17, 18, and so on. They grow every year by themselves. So that means last year, the cohort of 2016 made less money than this year, and so on and so forth, right? So this thing just like grows by itself. That's why it's so valuable. If you have less than 100% revenue retention, that means that the cohorts by themselves are not growing. They're like stable. If it's less than 100%, they're shrinking. More than 100% is of course great. In our case, we have really, really small customers, almost consumer-like behavior. For that, actually, a retention of 60% is already pretty good, but we are not getting any credits here. It's rather like a topic. Then EBITDA margin, less than 30% is a 0, north of 30%, 0.5. LTV CAC ratio. This is interesting. You always focus on LTV CAC and you're like, it has to be a north of 3, north of 3, especially if you're in the consumer space. If you're in the enterprise SaaS space, you want to have north of 10, but you know what? Like you get here only a 0.5 value add. You only get a 0.5 on top if you have an LTV CAC of more than 10. Why is that? Because if you're already growing like crazy and you have crazy revenue retention, that's already baked in the scoring. So an additional more than 10 to 1 ratio would only for that reason give you like a small increase, right? And then in this case here, if you have a revenue growth of 20%, which is great, retention 60%, it's actually also not that bad. EBITDA margin, you're making millions. LTV CAC 5 to 1 is pretty good. But still, you're not getting any value added. So that means you're on a 2.5x multiple. And then the question is, are there any subtractors? If you have key man risk, which means that you are essentially responsible for your business, and if you leave everything just falls into pieces, then there's a clear key man risk and you get a 3 here. Otherwise, it's a 0. Key client risk, all your revenue depends on one client. Single channel risk means you are just like doing one marketing channel and that's it. In the beginning, it's not so important to have like multiple channels, but the further you grow, the more important it is. So give yourself a 1 if that's a risk or a 0 if not. Market risk is if the market is imploding. Data is if you just like have no clue what your data is. So in this case, it could be a subtraction of 4. So that means you have a multiple of minus 0.5. You then not have to pay to sell your company, but essentially it's not worth a lot. And that's it, right? So how do we actually get this enterprise value? up because this is supposed to be north of 100 million, right? So here's what you do. Let's say end of this year, you want to be at 18 million. That's the 20% growth, right? And let's say also your EBITDA is not growing crazy. So this will still give you a 2.5. But then let's say you get your retention up to 80%, right? So that's a two on top. And all of a sudden you get here a 2, and you get the key man risk out, and you can add one more channel to it. Let's say you're strong on Meta. What if you add YouTube? All of a sudden you can get that risk out, and then you're at 4.5. The thing is worth 81 million. I think in terms of SaaS, this is also good here because the EBITDA is low enough that you wouldn't get an EBITDA multiple. You would still get a revenue multiple. And the company would be worth around that. Yeah, it would be pretty good. Even also post-COVID, multiples just have come up by like 1x or so over the last 2 years. The market is up again, not like it was in 2021, but it's significantly better than it was the last 2 years. Okay, so what's the goal then maybe for 2026 for you? So what if you bring in 25 million and you actually really get the profit up to 7.5? All of a sudden you get here a multiple of 5. Then revenue growth is up. You get a 1 here because you're north of 30%. You still have the 80% revenue retention. It's a 2. EBITDA margin north of 30%. It's a 1. You get an all of a sudden value added multiple of 4. You took all the risk out, so no subtraction. That gives you a 9 multiple. And if you're now a SaaS, I think you would still get here the multiple on revenue, not on EBITDA. And for that reason, you would be worth north of 200 million, right? And you know what, like to go from 15 million to just above 20 million and to become a little bit more profitable, right? Like take human risk out and get retention up. Of course, like these are big projects, but it's easier than building a new company from scratch and getting that to 20 millions. And in the end, you know, like you want to create a valuable asset, a valuable product, meaning in terms of asset that you can then sell to a potential acquirer, right? And there you have, let's say, financial buyers that are looking very much into the data. It's all about data. They're just like, okay, what money printing machine am I buying? How am I evaluating this? And there will be a bidding war, and then in the end people will buy it. Or if you're lucky, you get a strategic and then you can maybe get a higher multiple, but this is less likely. So it's like moonshot but possible. Anyways, if you want to sell your company at some point, you have to have an exit strategy in place. You have to prepare your company. You have to see it as an asset in order to really create something which is sellable. Otherwise, no one is going to buy your company. And in 90% of cases, your company is just worth nothing or it's not sellable because you're the person in charge. Your numbers don't add up. And in the end, yeah, that's it, right? So it's not sellable. So if you want to sell, look at that. A couple of thoughts actually I want to share with you here, which is for us to crack the 200 million valuation, we have to be in the 20 million EBITDA, 20 million revenue range, right? There has to be growth. The retention is the biggest valuation killer. And also growth killer. So getting valuation up is driven by retention. And in our case, I would say for most businesses. That's why every investor or acquirer will always ask you for your retention. If you become big, let's say, I don't know, 50 million, 100 million, or like a cash printing machine, then you have more and more targets that just buy EBITDA. They buy you on a multiple of EBITDA. For example, Sage is a company making 100 million EBITDA plus minus. So they need to grow organically, but also through M&A, right? And half of most companies then just like buy EBITDA because they have to show growth. And then you just look at you, how well do you fit in? They give you a multiple. And actually for them, it makes sense because the multiple that they pay you, which is cool for you, is for them much higher because they have less risk because they are bigger. Let's say at 100 million plus valuation, $1 billion play, soon to be IPO, you get a much better multiple just because you're bigger. So that means they can buy you for half the price of what your company is actually worth in the second once they bought you, right? Then LTV/CAC ratio 5-1 in the consumer space, 3-1, whatever. Everything north of 3-1 is fine. In the enterprise space, north of 10-1. Keyman risk, if you have founder-led sales, I would put brand faces. You could put a sales team in place, doing it old school, but you can also put brand faces in place to become more founder independent and have an independent GTM of founders. Then key client risk, I would say yes, of course, 10, 20, like 80% of your revenue should not come from 20% of your customers. I think that maybe would still be okay, but like the less the better. If you have 1, 2, 3, 4, 5 customers that make the majority of everything, that's going to be an issue because all of a sudden one person leaves you and the whole thing implodes and you don't have a business anymore. So that is obviously a big risk. Single channel risk, yeah, just at some point at the second channel, there are billion-dollar companies out there that are pumping and are like really valuable with just one marketing channel. So don't stress, but it would be good to have another one. Then market risk, of course. If you're on a market that is exploding, that is perfect. You have less competition, you have lots of tailwinds, perfect. And then here, of course, if you have a Google Sheet empire, you want to have real-time data that is available at all times on a pull. So that means you just like click a button, you get all of that stuff automatically pulled. That's where you want to be pre-exit, because the auditors and the acquirers, they just expect data literacy and externally audited data. Okay, and that's how you get your company value from 0 up to 225 million. I hope that was helpful, and I will keep you posted in case you're interested. What else will happen here in Vegas on the level 2 of the value acceleration method by Alex Hormozi, a $45,000 product. So let me know and watch the other videos around here.